everybody, and welcome to Enlightened Investor. I'm your host, Dr. Joshua Lure from Bradley University, and that man right there is Mr. Fiduciary Mike Mahoney.
Okay, the fiduciary.
Yeah, gotta get that in there.
Yeah.
Today's episode number 9 on $29 trillion. You have my attention. And what's today's topic on, Mike? Really about?
This is the economist episode. I don't think you're going to hear a lot from me. We're talking about debt, national debt, right?
National debt,
Yes.
yeah. So we have 4 things on our agenda, right? We're going to take a look at, number 1, how much debt is out there and what kind of momentum are we seeing? Number 2, should I be worried as an investor? And I'm going to take you through a little methodology that I call Corporation USA. I think you're going to like this, Mike.
Great. Looking forward to the Economist Day. Again, as I say.
Economist Day.
Not much for the advisor today, a lot for the economist.
Oh, the most important thing is coming at the end for you, buddy.
Okay, perfect.
Number 3 is how can we reduce our national debt and do it in a way that doesn't crush our economy? And then the last thing is his show, is what we should invest in an inflating and debt world, right? So,
sure. Well, all kidding aside, I mean, we all have children too. And I mean, this debt's going to just continue to get larger and larger, and eventually, hopefully, they do something, right?
Yep, exactly. I got my cup here today from my daughter, so we don't want to leave her with a bunch of coal.
Exactly.
Yeah.
Best dad in the world. Shout out to her.
So, debt is not always a bad thing, however, right? People can use it, countries can use it to cement the country. What did Alexander Hamilton say about national debt in one of his quotes, Mike?
Thank you. Teed me up there on that one. A national debt, if not excessive, will be to us a national blessing.
Right. So there's some great things we can do with our debt. Like, hey, we can take this debt, which we can borrow at 1.5%, and what can we get on it? What can we get? Joe Biden's pushing the infrastructure plan.
Right.
The rate of return on infrastructure is about 15%. So it makes a lot of sense in terms of just a cost benefit analysis to apply some of that debt toward investments that are productive.
Right. Okay.
But
Alexander
Hamilton also wrote we have to figure out a way to extinguish the debt if it gets too big as well. So the United States obviously is the largest country in the world still, but at the same time we have the largest debt that any country has.
Right.
$29 trillion, and that's broken down into 2 parts. There's $22.5 trillion that's debt held by the public, and then intergovernmental holding, which is kind of made up of our Social Security Trust Fund and things like that. It's about $6.3 trillion. So a total of about 28.8, about 29 trillion. What's interesting is this momentum is going to carry us to next year in 2022. We'll have about $31 trillion. So what's kind of scary, guys, is that the number's big, and if you want to go out and look at the website called U.S. Debt Clock, it'll just have all these numbers running continuously, and we're going to have a link. Ryan's going to put a link in the bottom of the description to anyone who wants to go look at that debt clock. Okay, they can go look at it. But
trillion here and a trillion here, and pretty soon you're talking about a lot of money, right?
Right. And one of the things that Mike and I recommend really is diversify your portfolio and put a little bit in bonds. So one of the blessings we get from national debt is that you and I own our own country's debt. We own that, and we can invest in it and earn a rate of return that's pretty much guaranteed, right? So it's that what's potentially dangerous is having foreign countries own large fractions of our debt. And right now, the national debt, about 26% of the national debt, about $7.5 trillion, is owned by mainly our trade partners that we have deficits with. So who are some of those trade partners?
I'm looking over at your computer. So our trade partner number 1 is China. I don't know. That's kind of a scary thought, but
China and Japan,
that's another
right?
topic.
So if we have trade deficits, what do they want? They want assets in return. So some of those countries will accumulate quite a bit. So let's take a look at maybe projections. We'll move on in our agenda. So projections are from the Congressional Budget Office that we're going to add about $5 trillion, $4.8 trillion in the next 5 years to our national debt. So that puts us about 33.6. That number does not, ladies and gentlemen, does not include anything from the Build Back Better plan, the trillions of dollars on that. It's a very conservative plan. So if you're looking at maybe $33.6 trillion of debt in 2026, if you were at 1.5% interest, the payment scenario would be about $504 billion. But if interest rates kind of somewhat even normalized, don't go back to 6%, but let's just say 4%, Mike, the interest payments alone annual would be like 1.3 trillion, which is even more than our Social Security and Medicare. You're talking about 25% of our budget is going to be put into interest rates. So that just limits our country's
Spending ability, right?
spending abilities. Okay, so the second thing on our agenda is, should we be worried about it, right? So one of the things I'd like to take us through here is Corporation USA. And so how bad is debt? And I think we know that, many business owners, countries, corporations, they use debt in leverage to fulfill their goals. But you have to be careful about it, right?
Sure.
So the difference between a corporation and the United States government is that the government could potentially have an infinite life, right? Like, the U.S. government could live forever. And so we have multiple millions of years of data on what is the optimum debt to like, say, corporate value, but what's the best debt to country value? And so, so that's kind of what we're looking at here, is like, how do you, weigh the costs of debt and the benefits of debt, right? So the cost of debt's pretty cheap, like we said, like 1.5, 1.6%. But if we have international trading partners, the benefit of like having a debt on trade is about 20%. And Build Back Better plan with Biden, he wants to build like roads and infrastructure. A recent article by Hubbard in 2021, and Ryan's going to link that in our below in our description. It reports that there's a 15% on infrastructure, right? So anyways, let's take a look at 3 ways to measure the value of a country. So we're going to take a look at our debt, and we're going to take a look at the value of the country. There's 3 ways I want to measure that. The first way is gross domestic product. So gross domestic product obviously is the value of all production in a country in a year. And in 2021, we're kind of estimating that to be about 22.7, maybe $23 trillion. And so that puts us at about 127% debt to GDP ratio. And that's so much higher than what we've ever seen, except for like World War II, Mike, and the Great Depression. So we've really kind of went in a period of where we had lower, maybe 50% debt to GDP ratio, and now we're back up to above 100%, which gives us a little bit of pause. We're not as high as Japan. We're not as high as like some Greece and other countries, but we're definitely not as low as most Asian countries and Germany. Those
developing world. It's bad if you're starting to look like a third world country, I guess, right?
Right. So we don't want to continue on this path. The second way to kind of measure the value of a country is to take a look at like the tangible wealth of a country, right? So like for example, some of you might be looking at getting a house out there. It says like, the housing boom market, and people say you should only have about 2 to 2.5 times your income toward like, your home. So one of the ways you can think about this for the United States is like, well, how much wealth is there in the United States? And according to the Federal Reserve flow of funds, total U.S. wealth for households and nonprofit organizations, this doesn't include corporations, is about 127 trillion. And that is only about 23% of our assets, our debt is. So it feels a little bit better. We might not have a problem with that. But the big problem is like, how long would it take us to actually pay back this debt? If we actually had the fortitude and austerity really to like say, we're going to get serious about our national debt. We don't want our kids and our grandkids, little Sebastian, to have all this debt wrapped around their necks. So how long would it take? 7.5 years. So if we look at government revenue and we put all of our revenue toward paying back this debt, our federal reserves are about $3.8 trillion. It would take 7.5 years, 750%. So that's above that, how much house did you take out as an individual, right? I mean, I know you only live, 100 years, whatever, and a country could live forever, but we're well beyond the 200 and 250%. So, okay, so the last thing in this part is like, what do we risk? How could it affect you?
Have we scared everyone?
Have we scared everyone? and most of these things are bad, right?
Economist day.
Yeah, the dismal science.
Ask the advisor, what do we do, right?
Yeah, what do we do? I mean, Ben Franklin would say, like, what do we risk when we have all this stuff, right?
Right, sure.
And what we risk with debt is we have potentially a higher interest rate on this out of control debt issuance. If the global financial system says, hey, listen, we don't want any more of this debt, there is more risks associated with it than there was 10 years ago, you're going to have to pay me a higher rate. So you might see higher interest rates. That does have a negative effect on equities and things like this, right? Slower economic growth and some crowding out effects. What we talked about before, Mike, is the value of the dollar might fall.
Right.
And potentially higher taxes. And I think what we'll see mainly is like some of our social programs will be means tested. Like, hey, you know that Social Security that we talked about, and you plug in the numbers for all your clients. You might have to like means test that a little bit and say, geez, you might not get exactly what you were thinking you would get because of higher taxes and lower maybe potential benefits. The third issue on the agenda today is how do we fix this, right? So we kind of like talked about here's the size and the momentum, and here's some of the, should we be worried about it, and some of the things you can expect, like the dollar should probably devalue in the future. How do we fix this that doesn't crush our country? And so let's get into like economic austerity. And one of the most famous articles on this is from 2010. The International Monetary System generated an article that was called Will It Hurt? Macroeconomic Effects of Fiscal Consolidation. And they have three primary findings. And really the finding that I want to talk to you today about is that the finding is that when you do austerity, it does hurt. It does reduce when you raise taxes and when you cut spending, it does decrease our economic growth. And the best way to maybe handle this austerity is to do some of these government spending cuts rather than increasing taxes all the time.
I don't think we're talking about that right now.
No.
No cuts on the table.
No cuts on the table. I mean, from George Bush increasing Medicare on Part D to last night on the round table with Joe Biden, that this Build Back Better plan has no tax implications. It's just all about spend.
Right.
So I think we know that our country really is in a point where we don't have a lot of political will to tackle this issue right now. And I think that worries people, Mike, and it worries some of your clients. And so the last thing I want to talk about is like, what can we do as retail investors to kind of shield ourselves from some of those negative consequences that come from inflation, dollar debasement, and growing national debt. So, Mike, what's some of your recommendations?
Now you've scared everyone. What's the answer?
Yeah.
I mean, this is a topic that I think I've heard through the years from numerous people, and unfortunately, I mean, there's an old saying that says there's been more money lost preparing for a downturn than's actually occurred in a downturn. So when I look at that, because what obviously you can go back to our inflation video and you can see some of the recommendations we made. But when you get talking about inflation, people start to talk about if we're going to devalue the dollar, we need to own gold, or we need to own commodities, or we need to own silver, and it's better, I think, really to just stay diversified in your portfolio that's in equities. If you look at it long term, even though equities get impacted with inflation long term, they're basically your primary driver of getting a good real return, right, over the nominal return. And then as far as owning your bonds, I mean, you mentioned lightly about corporate bonds and government bonds, but I mean, you think about it, government bonds are backed by the full faith and credit of the government. Corporate bonds, those are backed by the full faith and credit of the corporation, and corporations can go bankrupt, right? So that's not investment grade fixed income. So you want to keep your fixed income investments investment grade. And again, if we're going to get inflation, you don't want to be long on bonds because they would get crushed, right? They're going to have like equity like downside. So that's a negative as well. And then the key, again, like I mentioned, I mean, I've seen this through the years, people, regardless of what the topic is, whether it's a government debt or different things, but there's always some gloom and doom and some reason why to be prepared for the next crash, because that's really, we're overdue for a downturn right now, right? Dip, drop, whatever you want to call it, crash. And I've seen more people that have reacted have lost money, because once you react and you do something, then you're sitting on the sidelines, and if it doesn't occur, you're sitting waiting, and then when do you get back in, when do you do it? So the key is don't take any more risk than you need to take, and you have the ability to take, or the willingness to take.
Yep.
and diversify the heck out of what risk you are taking, right? I mean, individual stocks, again, I think that's a fool's play too. If you want to play around and own a couple individual stocks, it's great. But if you're going to sit there and have your portfolio, the equity portfolio portion built with individual securities, again, you're taking undue risk. It's just idiosyncratic risk that you're not getting rewarded for, right? It's uncompensated.
Uncompensated risk.
We'll talk about that in a future video topic, but yeah.
Can't wait.
But that's about all I have to say. I mean,
Great. Well, I think
mainly Economist Day and not Advisor Day today.
Right. And, I think you and I did mention before our show today that we've had clients and I've had friends that actually just kind of get scared. And this is just noise here.
Rightly so.
And they get scared and they they dive out and they just don't stick with their plan. And remember Eugene Fama said, your money's like soap. The more you handle it, it just deteriorates.
Sure.
So stick with your plan, folks. I think in a time during inflation and debt is to own assets. And as Warren Buffett said, a diversified portfolio with equities, they can raise prices if there is inflation, and it can be that their margins can be maintained. So it's like,
well, yeah, I think I'll add this
bit.
too. I mean, you look at it, even if you look at worst case scenario, you look at the Great Depression, if you've got enough in your portfolio in fixed income to make it through 7 to 10 years, you're going to ride out the Great Depression even.
Right. Long run, you're in good shape.
I've seen things where they say 5 years. I think that's really light. If you're retired, you better have at least 7 to 10, if not more. Think about the more years of spending you have in fixed income, the better off you are. But you still got to cushion that with equities to grow the portfolio overall. You can't. I'm not just recommending go out and buy a portfolio of 100% fixed income because inflation is going to be a risk that you're going to run as well. It's just you're not going to see it. It's going to take longer time to really have it erode your money.
Yep. Well, folks, let's go ahead and wrap this up. Today, we went over 4 basic things. We looked at the debt and its momentum. We looked at whether or not you should be worried about it. How can the country kind of move toward austerity in at least contractionary way? And then definitely some recommendations. And don't get hot and bothered about this thing. This is, again, in your long-term objectives, stick with your plan. So we appreciate you being here today. Mike and I we've put together a website called Enlightened Investor.com, where we have blogs, we've got materials there that you can come and look at. And really, if you scroll down on our webpage, if you scroll down on the main page, there's a link to contact us. And I know a few of you have, but we definitely want to hear back from you a bit more. So thanks for watching today's show. And this is the Enlightened Investor team out.